PCCs are single legal entities in which third parties are allowed to enter as cell shareholders, with the cell's business ring-fenced and accounted separately. Each cell's assets and liabilities accrue solely to the shareholders of that cell, hence the name protected cells. These could be used for multiple purposes, such as captive risk financing or writing third-party business for added revenue and profit. As a full EU member state, cells in Maltese PCCs are allowed to write directly into Europe, eliminating the need of having additional fronting insurers. Solvency II is the EU regulatory framework for insurers that determines capital, governance and reporting requirements based on the risk profile of each individual insurance company. The Maltese PCC, as a single legal entity, provides benefits on all Solvency II pillars, not only often reducing capital requirements, but also allowing substantial cost burden sharing. Solvency II technical specifications already cater for the protected cells, which are treated as ring-fenced funds. While absolutely protected from the liabilities of the core or the other cells, a cell will not have to be capitalized to the minimum EU directive requirements for standalone insurers, so long as the requirements are met by the PCC as a whole. A fully operational PCC will also have risk management and governance requirements already catered for. This includes, for example, the possibility of producing a single own risk solvency assessment report for the entire PCC rather than each individual cell. The same applies to other reporting and disclosure requirements where all the resources will be in place to meet the quarterly and annual reporting requirements as one single legal entity. Protected cells are truly flexible, especially in Malta, and can be used in a multitude of circumstances. Examples include cells as captive self-insurance vehicles. Such provide access to the reinsurance market with a lower cost per unit of cover versus the primary insurance market. Businesses outside the insurance sector have created cells to sell insurance to their third-party clients across the European Union. Non-European insurers have set up cells as fronting facilities in order to reduce their fronting costs. Cells could, for example, also be used to handle run-off business. Maltese regulations cater for protected cells that choose to be managed by third-party licensed insurance managers. By example, leading international management companies effectively use us, Atlas, as PCC hosts for their clients. This is achieved through an outsourcing agreement with the manager in respect of the specific cells they introduce. The prospective cell owner will get in touch with an insurance manager or a protected cell company. These will usually have an initial exchange to understand the context of the inquiry and whether there are any material aspects that make such proposal fall outside of the PCC's own risk appetite, or put into some doubt the cell's feasibility. This can be typically arranged by a video or teleconference call. The client will get some indications on cost and other requirements following this exchange. If the initial information is positive and the PCC does not see any material obstacles, many will seek to be formally engaged to assess the proposal in more detail. The additional information needed to complete the assessment would also cover a significant portion of the groundwork necessary for the potential cell setup phase, including preparation of the detailed financial projections and estimation of regulatory capital requirements. Typical information required would include background information on the ultimate beneficial owners, description of the insurance cover and underlying risks, the countries in which the risks are situated, sales method in the case of third-party business, intended claims handling arrangements and any other outsourcing, 3-year premium and claim projection estimates, the basis of the assumptions including any premium and claims history, and reinsurance structures envisaged, if any. Based on the information gathered in the assessment stage, the PCC, and if applicable the insurance manager, would assist in the application process, including the business plan and all other necessary application documentation to be presented to the regulator. These will also assist with subsequent meetings or correspondence exchanged with the regulator. Following due process, the regulator would then issue a letter that it is minded to approve the sale, with a few conditions including evidence that the required capital has been injected into the sale. The sales license is obtained shortly after it has injected the capital, and it can then commence its life and start writing insurance.